Okay, here's a thought for you. What if I told you that being the perfect bank customer, paying all your bills on time, never overdrafting, doing everything right, actually makes you one of the most profitable people for your bank? It sounds totally backward, I know, but it's the quiet secret behind how the whole system really works.
So, let's do a quick check-in. Just think about your own habits for a minute. Do you pay your bills on time? Like every single month without fail? And what about your accounts? Do you try to keep a pretty healthy balance in there, making sure you're not cutting it too close?
And I'm guessing you probably do everything you can to avoid those ridiculous overdraft fees and late penalties, right? I mean, who wouldn't? So, bottom line, you're a responsible customer.
Well, if you said yes to all that, then congratulations. You're not just the perfect customer, you're also the secret engine driving your bank's steadiest profits. I know, it sounds completely upside down, but let's dig into why it's true. This brings us to something we could call the good customer fallacy. You see, our common sense tells us that banks make their money when we mess up. But the real story? It's way more subtle than that. We all know about what you could call loud money. These are the obvious things, right? The overdraft fees, the late penalties, the stuff that gets our attention. But the real machine is fueled by quiet money. And that comes from things like interest rate spreads, tiny transaction fees, and, get this, stable loan payments from people who never miss one.
So what's the magic ingredient here? It all comes down to one single, powerful word: predictability. Your financial stability, your consistency, that is the most valuable asset you give your bank.
And predictability isn't just some vague idea. For a bank, it's an incredible financial tool. Because you're so consistent, the bank knows exactly what to expect. They can estimate how much cash they need, they can manage their risk, and most importantly, they can confidently lend out your money to other people.
And this is absolutely crucial to understand. Your money isn't just locked away in a vault with your name on it. No way. It's part of a massive, constantly moving pool of cash. It's being lent out for mortgages, for car loans, for business investments, and your stable deposits. They're the reliable bedrock of that entire system.
Okay, so how does your predictability actually turn into cold, hard cash for the bank? Well, let's break down the three main quiet streams of income that flow directly from you just being you.
First up is the interest rate spread. This one is so simple, but it is incredibly powerful. The bank pays you a teeny tiny interest rate on the money in your savings account, let's say 0.25%. Then they turn around and lend that exact same money out to someone else for a car loan at a much higher rate, like 6.5%. At that gap, in this case a massive 6.25%, that's pure profit for the bank. It's made possible by your stable deposit. They're basically using your money to make money, even if you never borrow a cent yourself.
The second stream? It happens literally every single time you swipe your debit or credit card. When you buy a coffee, there's this invisible process that kicks off. The coffee shop has to pay a small fee on that sale, and that fee gets split up between the payment networks and, you guessed it, your bank.
Now, you never actually see this fee. It's just a tiny little slice of each purchase. But think about it. Multiply that tiny slice by the millions and millions of transactions that responsible customers make every single day. The power isn't in the size of the fee, it's in the relentless, constant volume. And finally, let's talk about loans. You'd think that banks want people to miss payments and rack up penalties, right? It's the opposite. The absolute perfect loan customer is someone who pays every single installment right on time. Why? Because it means zero surprises, zero legal costs, and a perfectly predictable, stable income stream for the bank for years and years. So, you have these three quiet streams of income. Each one seems pretty small on its own, but there's a secret ingredient that turns these tiny streams into a massive river of profit. And that ingredient is time. Just look at how this compounds. On day one, it's just a few cents here and there from fees and interest. After a year, it's become a nice, steady income stream. Fast forward 10 years, and it's a major source of revenue for the bank. And over a 30-year relationship with a customer like you, it becomes a massive pile of profit, all built on your consistency. And that's the real paradox here. For you, the customer, the goal is a calm, stable, uneventful financial life. No drama. But for the bank, that total lack of drama is the perfect environment for these tiny profit margins to quietly grow into something absolutely enormous over time.
So what's the big idea we should walk away with? We kind of need to flip our whole understanding of the banking system. Its foundation isn't actually built on profiting from our mistakes, it's built on order.
The real pillars of bank profits are these three simple, incredibly powerful concepts. Order, which comes from your predictable behavior.
Repetition from all those daily transactions, and time, the great amplifier that makes it all grow.
And this quote from our source material just says it all perfectly. People who behave responsibly are not outside the system's profit model. They are a central part of it. You're not an exception to the rule. You are the rule that makes the most stable parts of the system work.
So, the next time you pay a bill right on time or swipe your card for groceries, just remember this. You're not just practicing good financial hygiene. You're playing an essential role in a system that is quietly, brilliantly designed to profit from your success. Now that you see that quiet logic, does your bank look a little different?